Well, thank you very much for joining me in this video. As I'm sure all of you are aware, the Government of Canada recently has sort of tinkered with capital gains and capital gains rates. I found there's some confusion about it, so I thought it wouldn't hurt to take a couple of minutes and talk about what's going on with capital gains. First of all, I want to make sure you understand what a capital gain is. If you have some kind of a product that you sell and you sell it for more than you bought it for, that lift profit is called capital gain. And as most things in life, it's subject to taxation. The difference is it isn't taxed dollar for dollar. What happens is the amount of profit you make on that capital gain is depreciated a certain amount, and that's called an inclusion rate. And what they do is they multiply the profit by a certain inclusion rate, and that lower amount is what goes on your income tax, the same as if you received it in a paycheck. Now, for years and years, it's been sitting at 50%. That means that if you, for example, bought something for $100,000 and you later sold it for $600,000 net after expenses and so on, that means you made a profit of $500,000. You would multiply that by the 50% inclusion rate, and that would mean the number would become $250,000, and that's what would go on your income tax, just as though you were paid it in a paycheck. Well, I've seen the capital gains as high as 75% over the years, but for quite some time, it's been 50% up until now. What's happened as of June the 25th of this year is for individuals that inclusion rate, it stays at 50% for the first $250,000, and then beyond $250,000, it increases to 66 2/3%. So, for example, going back to our example, if you bought something for $500,000 and you sold it for $1 million, your capital gain would be $500,000. Up until June 25th, you'd multiply it by 50%, and the amount you would be taxed on is $250,000. That's changed now. Now, the first $250,000 of capital gain is at 50%, and so that would be $125,000 of profit you would be taxed on. But the next $250,000 at 66.7 rounded off percent is $166,750. So now your total amount you're going to add to your taxes is $291,750 instead of $250,000. That means the added amount of money you're going to pay tax on is $41,750. If you're at a marginal tax rate of 53%, for example, that means it's going to cost you an additional $22,127.50 in tax with this new change. One of the things you got to be very aware of as realtors is sometimes we're working with an estate sale, and the people who are involved in settling the estate have to pay this, what they call a deemed disposition upon the person's death, and their estate has to pay the capital gains tax, and that capital gains tax is going to be higher than they were used to in the past. So that's what's gone on there, but there's also some changes to corporations that you need to understand. First of all, let's suppose you own investment property or your client owns investment property, but in the name of a corporation, often a numbered company. Well, the change in inclusion rate from 50% to 66 2/3% is now not after $250,000. For corporations, it's from $1. So if, again, you've got a capital gain of $500,000, it means you're going to be taxed on an additional $83,500 in income. While we're on corporations, let me say a couple of other things. If you're selling the shares of a corporation, if you're selling the corporation, but it's a share sale, not an asset sale, it was, up until this new budget, it was exempt for the first $1 million. So somebody owning the corporation could sell the corporation, and they were tax exempt for the first $1 million. And now it's exempt to $1,250,000. So it's raised a little bit, and it is indexed to inflation. But the inclusion rate before the budget was 50% on anything over $1 million. Now, after June 25th, the inclusion rate for the first course, $1.25 million, is zero, But the next $250,000 in capital gain is 50%, which is what we were used to. But anything over $1,500,000 is now 66.7% in inclusion rate. So that's up quite a bit. The other thing is looking way ahead. They're forecasting for July 2028, it's going to change as such. The first 1,250,000 will be a zero inclusion rate. The next 1 million will be 33.3% inclusion rate. The next 250,000 will be at 50%, and then anything over will be at 66.7%. So the larger corporations being sold as a share, it's going to cost a lot more money. There'll be a less amount of money to enjoy a free ride for, but there still will be this breathing room, if you like, for corporations that are being sold for 1.25 million or less. Hope that all makes sense. I do put it on the screen because there's a lot of numbers there and you need to be aware of it. Thank you for joining me in this video. Talk to you again next week.